A trading edge is a condition or set of conditions that, when present, give a higher probability of a trade working than not working. Traders always look for an edge, an advantage over fellow traders. Like knights shopping for swords, they are willing to pay handsomely for their trading tools. No price is too high if it lets them tap into a money pipeline. Earlier, I had explained why do casinos make consistent money on an event that has a random outcome. Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of the favorable odds, they have to participate in every event. They can't engage in the process of picking and choosing which hand of blackjack or roll of the dice they are going to participate in by trying to predict in advance the outcome of each of these individual events. Consistently successful traders use the same thinking strategy as the casino and professional gambler. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are precisely the same in trading as they are in gambling. Suppose the trader seizes the opportunity to take advantage of his edge and puts on a trade. What factors will determine whether the market unfolds in the direction of his edge or against it? The answer is the behavior of other traders. At the moment he puts trade on, and for as long as he chooses to stay in that trade, other traders will be participating in that market. They will be acting on their beliefs about what is high and what is low. At any given moment, some percentage of other traders will contribute to an outcome favorable to our trader's edge, and the participation of some percentage of traders will negate his edge. There's no way to know in advance how everyone else is going to behave and how their behavior will affect his trade, so the outcome of the trade is uncertain. Since trades have an uncertain outcome, then, like gambling, each trade has to be statistically independent of the next trade, the last trade, or any trades in the future, even though the trader may use the same set of known variables to identify his edge for each trade. If the outcome of each individual trade is statistically independent of every other trade, there must also be a random distribution between wins and losses in any given string or set of trades, even though the odds of success for each individual trade may be in the trader's favor. Consistently successful traders don't attempt to pick and choose their edges. At the micro level, consistently successful traders believe that each occurrence of their edge is unique. They understand at any given moment the market may look exactly the same on a chart as it did at some previous moment, and the geometric measurements and mathematical calculations used to determine each edge can be exactly the same from one edge to the next. But the actual consistency of the market itself from one moment to the next is never the same. They don't attempt to pick and choose the edges they believe are going to work and act on those, nor do they avoid the edges that, for whatever reason, they believe aren't going to work. If they did either of those things, they would be contradicting their belief that each occurrence of the edge is always unique. They have learned, usually quite painfully, that they don't know in advance which edges are going to work and which ones aren't. They have stopped trying to predict outcomes. They have found that by taking every edge, they correspondingly increase their sample size of trades, which, in turn, gives whatever edge they use ample opportunity to play itself out in their favor, just like the casinos. When you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. Predefining the risk doesn't pose a problem for these traders because they don't trade from a right or wrong perspective. They have learned that trading doesn't have anything to do with being right or wrong on any individual trade as long as you follow your trading plan. As a result, they don't perceive the risks of trading in the same way the typical trader does. You don't need to know what is going to happen next to make money. Why? because there is a random distribution between wins and losses for any given set of variables that define an edge. In other words, based on the past performance of your edge, you may know that out of the next 20 trades, 12 will be winners and 8 will be losers. What you don't know is the sequence of wins and losses, or how much money the market is going to make available on the winning trades. This truth makes trading a probability or numbers game. When you really believe that trading is simply a probability game, concepts like right and wrong or win and loss no longer have the same significance. As a result, your expectations will be in harmony with these possibilities. As a result, consistently successful traders with edge stay relaxed because they are committed and willing to let the probabilities, their edges, play themselves out, all the while knowing that if their edges are good enough and the sample sizes are big enough, they will come out net winners. Say you and I decide to flip a coin. When the coin lands on heads, I give you $60. If it lands on tails, you give me $20. In the short term, anything can show up, yes? Even though the bet isn't that advantageous for me, in the short term, I can hit a string of tails and you might end up paying me $80. But, as we keep tossing the coin, you're almost certain to win more than me. So, when playing a probability game, results matter, but they do not matter in the short term. Hence, in trading, if you're going through a string of losses, no matter how bad and painful it may look and feel, it is crucial to remind yourself that this is part of probabilities. If you're trading a proven system, the numbers will eventually work themselves out. No storm lasts forever. When you get attached to short-term outcomes, you freeze your desire into a rigid framework, which interferes with the whole idea of having the numbers work in your favor. Consider the following chart where the market has been identified as a ranging market. The edge in this scenario is that the price is trading in a range. The price is more likely to fall at the upper boundary and rise at the lower boundary. Based on this edge, you can use an indicator such as the stochastic indicator that signals when the price has reached the upper or lower boundary. The stochastic indicates when the upper boundary has been reached, and so, therefore, this produces a selling signal. The stochastic indicates when the lower boundary has been reached, and so, therefore, this produces a buying signal. These trading signals are still based on probability. In other words, if your indicator is producing a buying signal, then this does not mean the price will go up. It means that there is a higher probability of the price going up than going down in the current market conditions. The truth is, once you enter the market with any given trade, you are at the mercy of the markets. This is where a system or strategy comes into trading. A strategy is a set of rules that you trade by, and those rules are based on identifying an edge and then trading accordingly. This means that it does not matter if the trade wins or loses, because if you trade with a strategy based on an edge, then your trading system will produce winning trades over time that will make up for the losses. Building an edge comes through a combination of research and extensive testing. After some initial inspiration gives you an idea for a setup you can potentially integrate into your trading plan, the next step is putting some rules around it. Once you've got your rules, it's time to test and test some more. Run through historical data and do everything possible to approach it the same way you would if the market was real time and you were trading with meaningful size. When a valid trade comes up, don't hesitate. Take it. If it wins or loses, don't worry. It doesn't really matter what the outcome of that single trade is. Even with a strong edge, a single trade always has a random outcome. And even the highest probability setups can and do lose. To really know if what we have is a statistically significant edge, we need to test more than just a small handful of trades. You should look to test at least 20 trades for statistical significance that fit your setup criteria, and then sit back and take a good look at the numbers. Is it producing the desired profits? What about after factoring in trading costs? If everything looks good, it's time to go to the next step, testing some more. Yes, I realize that all this work isn't exactly the sexy part of being a trader, but to build confidence in one's edge, there must be a lot of data to back it up. So repeat the tests of 20 trades using different historical data. If you have run things through 3 times and all of them have shown that your setup has a substantial edge, then you can take things to the next level, which is live trading. This step takes a bit more time because you need to wait for your tested set to come up at least 20 times in live markets. Keep trading the way you did using your historical data, and don't start to become overly conservative or aggressive just because you are now live. This is actually a common mistake made by many new traders. But if you don't trade the same way that you test, what use is all that data? If you've made it through 20 live trades with your setup and you still have the same solid edge, then congratulations. You've just added a new setup to your trading plan. You now have the confidence, both historically and in real time, that this setup will make you money over a set of trades. This is extremely powerful, and it automatically puts you way ahead of 95% of the traders out there who don't put forth the effort to test their trading plan rigorously. Confidence in your trading edge is vital. Recall in the Trader's Mindset section, we talked about creating new beliefs to replace our inherited survival instincts. This confidence in your trading edge will play a paramount role in creation of those new beliefs. Any trader must have full confidence in the ability of their edge to provide them profits over time. Without confidence, a trader becomes far more susceptible to breaking their own rules and making foolish trading decisions. To have this confidence, we need 2 essential things. The first is the large sample of trades we discussed that cover both historical and live markets. With a statistically significant sample that has been properly tested, we can be confident in our positive expectancy over a large set of trades. The second crucial factor is that we can properly execute that tested edge. Just because we have a tested trading plan doesn't necessarily mean that our success is guaranteed. We need the patience and discipline to wait for the setups that fit our plan. And we need to be able to be fully prepared to enter the market when the moment presents itself. So how do we build and refine the mental aspects of our trading edge? In this case, there are a few shortcuts. It simply takes time, discipline, and the desire to improve persistently. Once you have done all the necessary work to have confidence in your edge, all you need now is the patience to wait for those setups to appear. Most people enter trades based on negative emotions, greed, and the fear of missing out. But consistently successful traders enter the market based on their edge. The key here is to have patience. Don't go anxiously searching for trades and willingly allow your trading edge to decrease. Sit back, assess the market with clarity, and attack only when your trading edge presents itself and the odds are stacked in your favor.